Well, hi everyone, Shaun Humphries here. Welcome to All Things Retirement. Well, in this installment, we are going to talk about generating income from your registered retirement income fund. So you've saved money for many years. You've built up, in this example, we're using $750,000 of capital in your RRSP account. You're now ready to take income. And the traditional way that we do that is we push money into a registered retirement income fund and then start systematic payments from that account. So again, we have $750,000 of capital. I'm using someone 65 years of age. And because I'm also going to show you an annuity quote as part of this example, we'll use a male age 65. So I think you'll find this a very practical illustration. Obviously, every situation's unique, and then some of the illustration will be generated off calculators that you can access through our website. So there's a link in the show notes to our website calculators, so feel free to visit that to do your own customized calculations. Now, if you're new to our channel, make sure you hit the subscribe button so you don't miss future content on various aspects of retirement planning and overall wealth planning. And as well, we've got some free resources you can access. Go to the show notes for that. And if you're looking to get a complimentary retirement forecast, there's a link in the notes so you can go back to our homepage to find out more information about that service. Okay, you'll see on the screen a calculator. It's called Will the Money Last? So how long will the money last essentially? And so we've got two scenarios set up here. So we've got $750,000 of RRIF capital in both of these accounts. We're using a rate of return of 4.5% and 6.5%. So let me unpack that for you. So we're always making assumptions based on the current reality. So if you look at the time this video was being prepared, guaranteed investment certificates, roughly speaking, we're paying in the range of 4.5%. So that's a risk-free rate of return. And if we look at the risk-free rate of return, and we wanted this portfolio to last until age 90, which is what I've used in this particular scenario, the maximum spend that we could have on the portfolio would be $49,000 per year on a pre-tax basis. And I say pre-tax because when the money comes out, there will be tax due on that. On average, what we typically see for many people would be anywhere from a 15 to a 20% effective tax rate. So in my example, take the $49,000, subtract 20% for tax, and that gives you essentially an approximation of the income you can generate if you're taking a really cautious, conservative approach to the portfolio. Now, the other example here is $750,000 using a 6.5% return. We're using 2% more than that. And actually, if you look at most balanced portfolios over time, expecting a 2% net return above the risk-free rate is not an aggressive assumption. That is very achievable over time. And so what's the difference in income? If you can get another 2%, so you move from a portfolio that is ultra-conservative to more of a balanced portfolio, the potential income would be $58,000 per year. So almost $10,000 per year more income, again, by the 25-year period. All capital is theoretically gone. If you want the capital obviously to last longer, in both of those examples, you would take less income from the portfolio. So if you go to this calculator, you can do your own what-if calculations on how long you want that capital to last. Now, the next one that we'll take a look at is inflation. So if you want to attach an inflation rate to each of these numbers, how much income could you take out? And then I will take a look at annuity rates. So if you decide to take your RRIF capital and give it to an insurance company, how much would they pay out for life, fully guaranteed without you having to worry about investing in the markets at all? Okay, now in this second example, all the assumptions stay the same. $750,000 of capital, 4.5% return, 6.5% return, but the main difference is a 3% inflation rate. So we want to have a number where we can take out a little bit more every single year so that the purchasing power of the income is maintained. All portfolio value in both examples will be depleted by the 25th year or age 90. And what you see is the income's dropped down. So if I looked at the previous example, we've gone from $49,000 per year to $36,000 per year in a scenario where you're buying guaranteed investments. And in a scenario where we are using a balanced portfolio, the income's gone from $58,000 per year to $48,000. So we have to reset our expectations about what we take from the portfolio so that the portfolio lasts long enough if we are increasing the income payments by 3% every single year. So you use the example down here. If I start with $36,000, by year 18, that income now is up to $59,000 in this example. So again, this is an example of a calculation. You'll want to go to the website to the calculator so you can do your own estimates. The work that we do for clients is this kind of work, where we're trying to establish what do we need to get as an income, what kind of returns do we need to achieve in the portfolio, and then what kind of investment mix has the highest probability for the lowest level of risk to achieve those kinds of returns for a client. Okay, so those are a couple scenarios to think about. The next one I want to take a look at is an annuity. So what if we just said, to heck with investing, I just want to take my capital and give it to an insurance company, and they'll pay me an income for the rest of my life no matter how long I live. So let's take a look at that example. Okay, so what you see on the screen in front of you is an annuity survey. We've surveyed a number of different companies. You can see on the list here is Sun Life, Empire Life, Canada Life, so some major life insurance companies in Canada. And this is for a male age 65, and the premium amount for the annuity is $750,000. So this money can be transferred on a tax-deferred basis directly to the insurance company, or from the RRSP directly, or from the Registered Retirement Income Fund. Now, once you transfer the capital, you lose all control of that capital. So what you're doing is you're saying, I'm going to forfeit the control of the capital for a monthly income that will be paid to me for as long as I live. So if I live to 90, 95, 100, 110, Sun Life will be on the hook to pay out that monthly income for as long as you live. Now, there's a lot of different kinds of guarantees that you can place on annuities. So I'm using a very simple illustration. In a few minutes, I'll talk about another option which has a survivorship benefit attached to it. But for this example, it's just a single life annuity, no guarantees. So what will that buy us as a monthly income? Well, from Sun Life, which was the best rate at the time we got this quote, is $4,574 per month. That translates to $54,888 per year. There's no indexing on that income. You can buy indexing annuities. They're more expensive. It would cost obviously more than $750,000 to get an income of the same amount, but that's indexed with a consumer price cost of living indexing on it. Now, why would someone do this? Why would they take their capital, give it to the insurance company, lose all control of the capital? There's no liquidity. You can never go back in and get some of that money back in case there's an expense that comes up you need to fund. Well, again, I've talked about it already. They're concerned about longevity risk. So they just are really concerned that they may outlive their capital. So they want to make sure that no matter how long they live, that monthly income will always be there. The second reason is, again, they may just not want to have to manage their portfolio. They want to turn over the management of the assets and not deal with capital markets or worrying about market risk, and just want the monthly income to keep their life simple. And for some people, it might be a combination where they may continue to manage a part of their RRIF account through investing, and then another part might go into an annuity option like this. Now, the other option we'll take a look at is a joint annuity. So it's reducing on the first to die. We've got a male and female, both age 65, and upon the first to die, there will be a continuation of the income of 2/3 the original income. So with that situation, again, it's $750,000 of premium. And you can see right here that the best rate in this situation was not Sun Life, but Bank of Montreal. The monthly income was $4,243. Again, these monthly incomes I'm quoting are pre-tax numbers. You'll have to take off tax. It might be 15 or 20% for the payment. Annualized, that translates to $50,916 per year. So those are the annuity options, and you can see there's a myriad of different strategies you can employ to generate different kinds of income scenarios. One of the most important things in this exercise is to use these tools connected to our website to do some calculations. If you're finding it to be a little bit overwhelming, then be sure to reach out to our office. We have a complimentary retirement income planning forecast that can shed some light in this important area. So make sure you take advantage of that if you're concerned about whether you're tracking in the right direction on some of these decisions. And as well, we've got some free resources that you can tap into. If you go to the show notes for this video, you'll be able to find links to those resources. Well, it's my hope that you found this video helpful. Anyway, I wish you all the best in both your retirement income planning and wealth planning journey. You take care. Bye-bye.